I am now deviating a little bit from the question. I'm just talking in a side way about the framework. Now, the framework allows mixed measurement. Now, what do I mean by mixed measurement? I mean cost and fair value coexist side by side. I mean, take PPE. Take PPE. We buy building 1, building 2, building 3. We buy car 1, car 2, car 3. We buy photocopier, computer 1, 2, 3. Now, our policy might be this. Let's revalue the buildings. If you revalue the buildings, the property, all of the buildings must be revalued because all of the assets in the same class must be revalued, and those valuations kept up to date. But just because you're revaluing your buildings doesn't mean to say that you have to revalue your cars or your computers. Most businesses will not revalue cars and computers. They will be kept at cost, but the buildings will be revalued. But on the balance sheet, you've got one number for PPE, 100. Now that number is a composite number. Some of it is at fair value and some of it is at cost. So it's a mixed measurement system. Agriculture. You are mandatorily required to have your agricultural assets, your biological assets, your animals, you're mandatorily required to have those at fair value. Whereas if you've got an equity investment, one that fails the cash flow test, that has to be at fair value too. So that derivatives have to be at fair value. So there are circumstances where fair value is mandated, but there are other circumstances where fair value is optional. Investment property, optional. Yeah? Cost is used. Cost is amortized cost for financial assets. Yeah? If it meets the cash flow test, then you have a financial asset at amortized cost. Inventory is at the lower of cost and net realizable value. So cost has a role. Cost is reliable. Cost is traditional. Cost has a role. Fair value has a role. But my head hurts. There is a small part of me which would like to have everything at cost. Reliable, past, I'm an auditor, tell me the cost, tick, tell me the cost, tick, I'm certain. Now that's not very useful. That's not very useful. There's another part of me which says I'd like everything at fair value. But fair value can be very subjective, and it would mean that you would overstate your assets on inventory and you would be anticipating profits, and maybe that's not a good thing either. So we have this horrible kind of mixed measurement system where we're not all cost and we're not all fair value, and individual accounting standards have to kind of work out whether they want to be at cost, whether they want to be at fair value, whether they want to sit on the fence. So the framework doesn't give us this firm steer. That's why accounting standards can conflict with each other over sometimes they're at cost and sometimes they're at fair value. I can't write all of that down. We live in a mixed measurement system. Some things are at cost, some things are at fair value, and that's not ideal. Yeah, it's not ideal, but it's the way it is. The framework is silent on when a gain or loss should go to the P&L and when a gain or loss should go to OCI. The framework gives no guidance on when you take gains and losses to P&L and when you take gains and losses to OCI. The role of the other comprehensive income is not set out in theory. So the other comprehensive income, to be honest, is a dog's dinner, is a mess. It's down to individual rules. If you buy PPE, the revaluation on PPE goes to other comprehensive income. If you buy an investment property, the gain on the investment property goes to P&L. They're both unrealised, but one goes in P&L, one goes in OCI. It's just a bit weird. Framework is silent on recycling. Therefore, it's rules-based. If it's rules-based, it becomes inconsistent. Look, I refer you to my previous discussion. ISA 16 says no recycling. ISA 21 says yes recycling. To me, that is two different rules coming into conflict with each other because there isn't a theory, there isn't a base, there isn't a foundation. There isn't an agreed strategy from the beginning. So individual standards have to come up with their own strategies. So the framework is silent on recycling. This is one of the reasons why the framework is up for revision. This is one of the reasons why the framework is subject to an exposure draft. The framework is not perfect. And because the base is not perfect and the principles are not perfect, the accounting standards that come out of that base and that principles, they're not perfect either. They're very, very good. They're very, very good. But we're always looking to improve. Yeah? Your role at P2 is not simply to say, I worship the standard. I worship the framework. Everything is absolutely brilliant. Your role, occasionally, is to be critical. Yeah? It's okay, but it could be better. It's okay, but it could be more consistent. Yeah? Blah, blah. Blah, 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 blah. So, yeah? So, this is why, one of the reasons why we have, our exposure draft. Are we okay with this? I'm about to sort of move on and get, I'm about to go back to the script. I'm going to go back to the question. What was the question? Problems with the definition. So the current definitions arguably could do with a little bit of sprucing up. The definition of equity is arguably a weak definition. We could do with more clarification as what is meant by equity. Arguably it's too dependent on what an asset is and what a liability is. So it's not a person in its own right. Yeah, it's not a person in its own right. It is a function of an asset and a liability. So it would be better to have a more sharper, better definition of equity. The distinction between debt and equity is something we'll look at in a second. We could have more clarification on control. Yeah, we could have more clarification on control, what is meant by control. Yeah, I mean, I think I know what is meant by control, but yeah, arguably, you know, if you're scratching around for something to say, yeah, we could have more guidance, more clarification on what is meant by control. Blah, 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 blah. 10 marks, no one's going to get 10 out of 10. But you need to write something down, all right? You have to say the framework is very strategic, long-term importance, encourages a principles-based approach. Principles are better than rules because you can get round rules. Yeah? You can get round rules. It's harder to get round principles when you've got ethical accountants. Yeah? Just before we move on to the case study part, just before we move on to the part, do I call it part B? Perhaps I should call it part B. For each of the transactions above, explain how it should be accounted for in accordance with the standard, and then discuss if the accounting treatment could be argued to contradict the definition of an element given by the framework. What happens when there is a conflict? What happens if your mother says to do one thing and your father says to do another? What? No, let's not go there. What happens if the standard says this is what you do, but you look at the framework, you look at the theory, you look at the principles, and that seems to suggest a different path? Who do you follow? Do you follow the standard or do you follow the principle? The standard, yeah. So the principle is airy-fairy, nice idea, but in day-to-day practice you must follow the accounting standard. I suppose it might mean that if the standard and the principles are at odds with each other, it means that we've got a weakness in the force. Yeah? We've got a weakness in our regulatory system, because they ought to be in harmony. And probably it means that we need to change the accounting standard, so the accounting standard gets revised in accordance with the framework. That would be my contribution at this stage. Where the framework and the standard conflict, follow the rule. Comply with the standard. Because by complying with the standard, you're giving a true and fair view. So where the framework and the standard conflict. No wonder you were looking at me as if I was mad. Where the framework and the standard conflict, follow the standard. Yeah, follow the standard. The situation where they are conflicting is an unsatisfactory situation. I don't like conflict. I mean, that's one of my personality traits. I don't like conflict. I grew up with 4 sisters. Don't like conflict. So when you've got the framework saying one thing and the standard saying another, it probably means that the standard is a weak standard because it ought to comply with the principles. But it may mean that the framework is a weak framework. Yeah. So whatever. Yeah. Blah blah blah, 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 and we have now got a lease situation. During the year, Janice has entered into a lease. The lease is for a photocopier. The lease is for 4 years. The photocopier is allegedly going to work for 10 years. So we have leased the asset for 4 years out of a possible 10 years. The lessor is responsible for the maintenance, and Janice pays the lessor annually in arrears. Now there are 2 distinct requirements to this scenario. How should it be accounted for? The accounting standard that is relevant for your exam is ISA 17 on leases. So let's put the framework to one side. There's 2 marks here. Let's put the framework to one side and just concentrate on leases. What type of lease is it? Operating, yeah. If we have a lease, we have to make a classification decision about whether the lease is finance or whether the lease is operating. That is a judgment issue, and that is a judgment issue as to whether at the inception of the lease substantially all the risks and rewards of ownership are passing. If substantially all the risks and rewards of ownership are passing, it's a finance lease. Recognise the asset, recognise the liability, depreciation, finance cost. It's what we did earlier today. But what we've got here is an operating lease. So we have a classification process. If we have a classification process, this is based on whether substantially all the risks and rewards of ownership pass. Based on whether substantially all the risks and rewards of ownership pass. We've come to the conclusion that it is an operating lease. And the justification for that is the risks and rewards are not passing because we're only getting the asset for 40% of its life. So we are only using 40% of the benefits. Now, what is the accounting treatment for that? The accounting treatment is that we will have a rental expense in the profit and loss account, and that there is no asset and there is no liability recognised in the financial statements.